So what should you be doing right now with your mortgage, or if you're looking to buy a home? That's exactly why we have Dan Clifton with us today. Dan, I want to welcome you to the page as we're sharing this to all of our existing clients or new relationships. Maybe you're out right now on Facebook as we're streaming this live. You've got questions. You're trying to figure out what should you be doing as we come out of COVID-19. Maybe you're a little bit cash strapped with that. So Dan, if kind of getting started, if you can give a little bit of background about yourself, about
Sure.
about your group.
Absolutely. Thanks very much, Andy. Pleasure to be here. I've been in the mortgage business since 2002. So I've been here before when we had the crash back in 2007, 2008. It's a little bit different this time because at that point, really credit wasn't available to people, but it is now. We're probably busier than we've ever been. Rates are super low. They're probably not as low as some people think they are, but they're still at all-time lows. So it's a great time to take a look at your mortgage and see how you can integrate that into your financial planning tool and get your mortgage to work for you versus you working for it.
Yeah, we had a lot of people, especially here in Central Florida, that experienced changes with their income, whether it's that a bonus that they were thinking they were going to get got chopped or completely eliminated. Maybe they've been furloughed or laid off, and they're trying to figure out, where do I start? So this
Mhm.
is one of the key resources that we've been using in our planning for the last couple months, is helping people out with where are opportunities that you have that you can stop losing money unknowingly and unnecessarily.
Yeah,
So this is one of those first areas. It's your mortgage, right? All of us
absolutely.
know that we have it. All of us know that it's going to come every single month, but yet how often do we look at it to see if we can save? So if
Mhm.
I'm sitting there right now and I'm watching this and I'm trying to figure out, should I be looking at this? Is there kind of like a measure that you look at that it says, hey, if you can save 1% on your current rate, that this makes sense? Is there kind of a barometer there?
Yeah, absolutely. There is a guideline for showing what's called a net tangible benefit for refinance. It's basically to ensure that the mortgage payment, and when I say the mortgage payment, we're talking about the principal and interest and mortgage insurance portion. Taxes and insurance are what they are regardless. So we're looking for that to go down a minimum of 5%. We're also looking for a recapture on your closing costs, right? Because there's closing costs. Um, there are companies that advertise, hey, we pay all your closing costs and so on, but really everybody does that. It's in exchange for a higher rate, so you have to look at the cost benefit on it. The litmus on that is a 48-month recoup on the closing costs. I like to see 36 months, and honestly, what I'm seeing with a lot of clients right now is we're getting a recoup on the closing costs in 12 months or less,
Wow.
just because the rates are so low and where they currently are. The other point that we look at too, which is very important, we like a 30-year fixed rate mortgage. The reason why is the difference between the rate from a 30-year to a 15-year isn't that big. And in the case of economic crisis, you don't want to be strapped into the 15-year loan. You can go to the 30-year loan. You have that extra cash flow. And what we like to look at is your payments when you reset your loan, because you've had your loan for 2, 3, 5, 10 years. You're resetting your loan back to a 30-year. We want to look at what you're saving over the life of the loan compared to the remaining payments on the current loan. And in many cases, most cases, even though you're resetting back to a 30-year, you're still paying less over the entire term of the loan compared to what you have remaining on your current loan. So those are the things that we like to look at to see, if it's a benefit for you.
Yeah, we see that when we have people that first come in and maybe they're new to our firm, and they kind of have this mindset that it says, Quicken tells me that a 30-year mortgage is bad, I should have a 15. And as we start going through it, I say, hey, you know why they're telling you that? They're telling you that because they get their money back quicker so they can lend it out to somebody else. So
Hmm.
banks are super happy when you do 15-year mortgages because they're just getting their money back that they lent to you quicker. There's a reason why they give a little bit better rate on that, and you feel like, hey, I'm paying my house off sooner. But when in fact, if you did the 30-year, you could actually come out further ahead.
Yeah,
So I
absolutely.
love that you're educating people with that all day long. It's one of those, as we're doing financial planning, sometimes it's a difference of what the heart tells you and what logic and math tell you.
Hmm. Yep.
We know that we have this as an uphill battle with some folks of saying, I've got to pay this house off as quick as I can. I'm entering into retirement. But we don't know when events like what we've just experienced are going to happen, right? You said it
Yeah.
yourself. You've been through this in 2008 with the housing crisis. Definitely a little bit different than what we're going through right now. Although, as these jobs continue with people lack of income and we get deeper into this, we'll see how that affects mortgage defaults and things of that nature. Because of that, I think that you were saying when we were offline a little bit earlier that there's been some changes with how banks are operating right now and requirements on mortgages. Is that correct?
Yeah, correct. Every lender, every loan investor has had what they call temporary guidance, which is basically speak for, hey, there's stuff going on that's beyond our control. So we're going to put in some additional measures here to make sure that the loans that we're writing are going to perform, meaning the borrower is going to pay the bill. And we've seen some tightening on that. And in the last week, we've seen some loosening on it. Some examples of some of the items that we've had is many lenders basically cut out FHA lending altogether, FHA and VA. And basically how they cut that out was they made their rates so high that it was basically a loan that fell into a high cost mortgage category, and you weren't allowed to originate it. A lot of those lenders have brought their pricing back on those. Um, Other lenders have increased their credit score requirements. Technically, there is no minimum credit score required on an FHA loan. But many lenders said, hey, we used to have a cap of 620 as the lowest score we would accept. Many have gone to 680. And some of those lenders have brought their credit scores back down. Other examples of some tightening that we had was self-employed borrowers. It was an automatic 25% cut to the qualifying income because of the uncertainty of the environment. Not able to use rental income as qualifying income on a loan for underwriting. So a lot of those things were, knee-jerk reactions, which, we understand, but policies have come back into place where it makes a lot more sense, where we can say, hey, for rental income, we can't use that unless you can show us that you've received this month's rent from your renter. That makes a lot more sense. And same thing on self-employment income. If you can show us bank statements that show that you're getting deposits that are consistent with your income from the previous year and the year before that, we can use it without any reduction. So a lot of those things have come back as things have kind of settled a little bit and fine-tuned.
So as we see that banks have changed with these regulations and kind of been fluid, we've seen it on our side with insurance companies,
Mm-hmm.
annuity offerings. It's all tied back to what rate they can make on the money themselves. So we see this, we kind of know that it's going to change. How, if I have not refinanced my house at this point, when should I be looking at that?
Now. So don't assume that you can't refinance or that it's not a benefit to you. And the mark of understanding that and knowing that you're working with a good mortgage person, whether it's me or somebody else, because there are a lot of good ones out there, and there's a lot of ones that aren't good. But the mark is when they can analyze your situation, and if it's a benefit to you, explain what the benefits are, and if it doesn't make sense, to say, hey, you know what, this just doesn't make sense for you. We're not going to write a loan for something that's going to put a borrower in a worse position or down the road, not make sense for them. But you don't know unless you ask.
So we have people that come in that when they bought their house, maybe it was 6, 7, 8 years back, they had
Mm-hmm.
went into their bank that they had a relationship with and they
Yeah.
got a mortgage. So now that you're telling folks, Dan, to go out and look at refinancing, what's the difference in going back to that bank versus going to a group like yourself?
Sure. So, a group like myself, we're a licensed lender, but basically what we do is we write loans with multiple different lender investors. So when I was talking earlier about some lenders have changed their requirement for a certain loan from a 620 score to a 680, if you go into a bank and their requirement is 680 and you've got a 679, they cannot help you. If you come into a group like me and you have a 679, this lender that I write the loan with I may not be able to do the loan with them, but I have a source for them. So that way you don't have to go from bank to bank to bank. And then in addition, I have multiple sources for that. Lots of brokers and lenders do, and just like myself. But if I have a loan that fits with these three different investors, I can see what the best rate and terms are for that. So you don't have to go shop around. You don't have to, travel to multiple different banks. You don't have to be out there in the public wearing masks and putting yourself at risk. So.
Yeah, I love that, because for our clients, we preach all the time of telling people, listen, we're going to be able to narrow down and give you the top 3 or 4 options here, versus you having to go out and talk to so many different people and then you try to compare and contrast to see what's going on.
Mm-hmm.
So if I was trying to shop for an annuity right now and figure out who's going to provide me the most guaranteed income for the rest of my life, or who's going to allow me to have the best terms to have growth, I want somebody that's independent that can go out and look for me. So I
Mm-hmm.
love that you're sitting there in your
Yeah.
seat saying, let me be I'll go out and do the research for you. Here are the different options. And you can present those and say, here are 3 different ways we can go. Here's the pro and con of each. You tell me which way is
Absolutely.
going to be
Yeah.
best for you.
Absolutely.
So we're sitting here, we're coming out of coronavirus. We're starting to see some of the businesses reopen. We're getting people back to work. But with mortgages, what do you see changing here in the next 3 to 6 months that might, be beneficial for people that are looking to purchase a new home?
Mm-hmm. Okay. So changing coming down the likes, I see rates still staying low for a period of time. There was a period in the last 2 months where they were up and down and all over the place for a variety of different reasons. They've stabilized and they're hanging out at all-time lows pretty much every day. So there's opportunity for individuals who are looking to purchase a home where they can get into the home that they wanted to before at less cost per month than what they otherwise would have had. And what I advise people is, hey, now you can afford more home because the payment's less, but look at the home that you wanted to get anyway, and now you can have a lower payment. Don't go up in price. Stay where you were at for your dream home, and that payment is now lower, and then you can use that extra cash flow for things such as investing and so on. And there's going to be a lot of opportunity for that.
Yeah, I was talking to someone the other day and they were saying, hey, this is great. We can go out, we can, get the upgrades that we wanted. We can go with a little bit bigger house. We can do this. And then as we started walking through it, we started looking at it going, well, that's going to cost a little extra to maintain. And do I really have the room, the margin in my spending plan? Even if I can afford more house, can I afford the upkeep on more house?
Mm-hmm.
So,
Yeah.
being able to work through that and having a professional that can guide you through and say, just because you can afford the payment doesn't necessarily mean that you can afford everything else that's going to come with it.
Yeah.
So that's where having that spending plan and fitting in to your point of having a clear picture and knowing exactly how this fits together, it just makes it all sing, as we put it.
Yeah, correct.
With that. So Dan, if I'm sitting there right now and I'm watching this and I'm trying to figure out why would I not call you? What would be a reason that you would tell somebody, you know what, don't even worry with it. It's not worth the phone call as you sit.
I can't think of too many. Maybe if you refinanced last week and you've closed already. But I mean, even so, I get clients that are, they just bought their home last year and they're like, oh, I don't think I can qualify because it's too soon. Well, there is no actual too soon for refinance. I've had clients come in where they've only have a couple of years left on their mortgage. And why do I want to reset it back to a 30-year? And again, that equity in the house is nice, but it doesn't make your house worth anymore, no matter how much you owe or don't owe on it. And that equity, you can't access it unless you sell your house or you have take out a mortgage to gain that equity back. And building a buffer, I don't invest in something, pay for some other bills. Again, I'm not advocating pulling money out and spending it on things you don't need to, but you need to look at the overall financial picture. So I can't think of too many reasons why you wouldn't reach out. There are cases where it doesn't make sense, and a good loan officer is going to tell you, hey, this doesn't make sense for you. I'm not going to write this loan for you.
Yeah, and that's one of the things that as we see entering into this, what we call new normal, is you need people that are going to be honest with you, give you clear feedback so that you can take action. To your point, when people are looking at it going, what if I have 2 years left? Why would I refinance? That same person might have just lost their job that they planned on working in for another 3 or 4 years so that that house would be paid off entering retirement. All of a sudden you lose $200,000 of income as a household. That can make a significant difference in how you're spending down your assets. So with that we've had people that I've talked to in the last couple of weeks that they said, I felt like my book got closed before I got done reading it.
Yep.
So if you're sitting there, you're experiencing that, and you want to have somebody that can help you out with taking action, this is the time to do that. So Dan, if somebody wants to reach out to you, what's the best way for someone to access information? Do you have a Facebook or a web page?
Sure. Yeah, we have web page and Facebook. So our website's cliftonmortgageservices.com. There's a rate request on there. There's a pre-qualification, pre-approval request on there. I know sometimes people are jittery about filling that out because it's personal info, but I never run credit without talking to a client first. I mean, the system does ask for permission to run credit, but never do that without talking to a client first and without sending them a quote first. So I'll get the info and send that over to them. They can fill that info out on there. They can email me, call me, text me. Calling is sometimes a little difficult because the phone rings nonstop. Email and text is great because I can reply to that at any time. And, I often get comments, wow, you're still at the office working. It's 9 o'clock at night. And I'm like, well, I saw an email pop through and I'll respond. So.
Yeah, and if you're sitting there and you want to see what difference the refinance that Dan can help you out with is going to really make with your world financially, we're happy to help with that any way that we can, because that way you can see not only are you going to save that potentially $300-400 a month, or save that 1 or 2% over the life of the loan. How are we going to see that makes more of your dreams come true? So Dan, I just want to thank you so much for taking the time, especially in between phone calls, so that we could try to connect with that. If anybody is looking for next steps, like Dan said, just go to his Facebook page, or you can access their website so that you can see what are some of the different offering services that they have. And if Dan can help you out, I'm sure he's happy to. So
absolutely.
Dan, thanks so much for your time today.
Absolutely. Pleasure to be here. Thank you very much.
Thank you for watching the Life Wealth Group YouTube channel. We hope you found this video informative. If you have any specific questions as to what you heard today, don't hesitate to reach out to us for a complimentary phone call or meeting in person. Also, don't forget to subscribe.